Gold is like your grandpa. Steady, strong, friendly, always going to be there for you. That's true. That's what gold is.
Hello and welcome to the VRIC Media channel, where our mission is to educate you on how to make money in the natural resource sector. I'm your host, Ted Butler, and today I'm very glad to be joined by newsletter writer, keynote speaker, and all-round mining industry legend, Jeff Clark. Jeff, I'm very much looking forward to hearing your thoughts on what I believe is a generational investment opportunity in the junior sector right now. So thanks for coming on to take the time to speak with me.
Absolutely. I'm glad to be here, Ted. And you took the words right out of my mouth. I do think, mining stocks could be the, investment of the decade for the rest of the decade. So.
Absolutely. Yeah. So obviously I do want to dig into some of the insights from your book, Payday, which I've been very much enjoying recently. But before that, I think I want to get straight into an article that you wrote and you published on the goldadvisor.com website a couple of weeks ago, and it was titled "The Fuse for Juniors Has Been Lit." And in it you state, "I'm calling it, the countdown to when money starts flowing into the junior stocks has begun." Obviously, this is a very bold claim, Jeff, but I know you wouldn't put your neck on the line like this unless you truly had a deep conviction for this thesis. So I guess naturally the first question is why is it you believe the fuse has been lit for juniors?
Well, you're right. I do hate making predictions. I used to do that all the time, and because people wanted to know, right? I'm an investor too, and I want to know, but it's just so easy to be wrong. I mean, there's hundreds of variables, thousands of factors and influences, millions of investors, billions of dollars, each with their own self-interest and pushing the prices of things around. So it's very easy to be wrong. It's not a 50-50 thing when you make a prediction. It's more like 99-1. 99 being you're probably going to be wrong. So I just don't like doing it. That said, I looked at what happened this past quarter. I had my eyes on it, and I do think that the time has come for when money is going to start to flow down to juniors. Now, I'm not saying it's starting now. I'm saying the fuse is lit, just like I titled that article, because the process has started of generalist and mainstream and Wall Street money moving into our sector. And what's interesting, Ted, it's not because of the soaring gold price, it's not because of the Fed, starting a cutting cycle here, we believe, later this month. It's not because of the fear of recession, a stock market crash, money printing that's probably inevitable at some point here with them. It has nothing to do with that. It's strictly based on one factor within our industry that I've been monitoring, and that is, how did the higher gold price impact earnings and cash flow?
Yeah.
We created a table for this, and I was myself, kind of astonished at how much earnings and cash flow improved for these producers. So we tracked 6 of them, and you can see in the table, I think you're going to put that up, that, I listed there the percent change for each of them. And these are, basically among the top 6 gold producers in North America, at least, let's put it that way. And you can see the percent change. The earnings went up by double digits, and for a new month, they went up by triple digits. But the real big thing was free cash flow. And a lot of analysts, consider free cash flow the more honest and valid measure of corporate health for a company. Because it's easier to tinker with and play with earnings, right? Less so with free cash flow. And if you look at the percent change there in the far right, I mean, these are all double digits, triple digits, and new month's free cash flow went up by almost 1,400% in Q2 of this year versus Q2 a year ago. And it's all because of the gold price. Yeah. Think about it. Costs have been rising, right? Inflation was going up. It was really eating into profits. It was really hurting developers who were in permitting and doing feasibility studies. All of a sudden, in 6 months, your feasibility study was invalid because inflation was rising so much.
Mhm.
But by the time Q2 rolled around this year, a lot of that had already settled down and plateaued and had been figured into costs. And the main change in their reports in Q2 this year was a substantially higher gold price. It was higher by $360, over 18% in that 12 months, which is pretty strong for what basically is a static metal, right?
Right.
So, when I look at that, that tells me that, first of all, we already have money flowing into the metals. It always starts with the metals, then goes to the big companies, then the developers, then finally down to the juniors. We know historically that's the pattern for how money flows into our sector. Well, we have it flowing into gold now, right? Look at the gold price. Number two, looks like now we're going to have money flowing into the producers because of the green on the screen, right? For Main Street, Wall Street, and all these other investors, generalist investors that are looking at this and thinking, wow, look at that. This will especially be true if the general stock market gets weak. If it has a correction, if it goes into a bear market, investors are going to be looking around where they can put money that's profitable. Well, this is going to be staring them in the face. And so I think the process of money flowing into the majors and the producers and that has started. Next will be developers, and next will be juniors. We don't know the time frame there. It could be in a couple months. It could be a year from now. But the fuse is lit. It has been lit. And it's my opinion, and my money's where my mouth is.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, US Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video.
I think it's going to flow down to the juniors here within a period of time that you're going to want to be long.
Very interesting, Jeff, and I would tend to agree absolutely. I think the question now that we've established why you believe the juniors are ready to outperform, I want to get a sense of how big you think this junior bull market could actually be relative to historical bull markets. Now, I think in your book, which I've got with me here, I think you talk about the runaway 70s where gold rose about 721% in the space of 3.5 years, I think. Silver rose about 1,063% in that same period. And then you had some junior mining companies. I think Copper Lake was the one you quoted, which increased by a staggering 13,000%. I mean, this is unbelievable. So when you fast forward to today, and we already have these gold prices rising to all-time highs, which you note in your book as one of the most important catalysts for what makes a gold mining stock go on a run. And then when you add in these sort of ancillary things like September being the best performing month on average in terms of seasonality for gold, a rate cut on its way from the Fed with gold being inversely correlated to rates. And then also you look at the BRICS appetite for gold as well. I think I saw today that Russia recently announced its plans to buy another 30 tons of gold. So I say all this to ask you one thing, Jeff. I mean, what parallels do you see between today's market conditions and the historical periods like the 1970s and the 2000s?
That's a great question. And the answer is this is probably going to be one of the bigger bull markets in mining stock history. Wow. That is another big statement, but I say it because if you look at the ratio of whether it's the HUI, the Barron's, GDX, their ratios to the gold price, believe it or not, they are still near historic lows.
Yeah.
Historic lows.
I know.
As we sit right now and talk, that tells me that we're starting from such a low base that once these mining stocks really get going, It's my opinion that when money starts to flow into our little junior sector, we see higher demand, we're going to see higher stock prices, we're going to probably see some easy doubles and triples. I think that's going to happen because it's happened before, A, and B, because we're starting from such a low base. They're so dramatically undervalued, and every junior mining investor knows that. They've been beat up and they're depressed, and it's not, they're not really moving. And so from that level to where, historically they could go is a very significant jump in share prices. So that's what I think is going to happen. But, again, that's another projection. I don't know that. Nobody knows that. But what I do know is that they're so undervalued and so beat up, and their ratios to gold and the general stock market, whatever you want to measure them against, are so low that the value is incredible. Mining is not going to go away. Mining is still going to be here. And at some point, I think investors are going to come into this sector, and from these low levels could really ignite share prices.
Wow. Yeah, I feel like I've just come into this at the right time when you say things like this. Because obviously it's been years.
There's a lot of examples in the book. I have just hundreds of examples of stocks that have hit pay dirt, throughout history. So it's not just the 1970s. It's literally every decade something happened that ignited mining stocks, even if the gold price didn't move. Now we have the gold price, at our back. So it would be abnormal. It would be historically abnormal for mining stocks not to respond at some point here. It would be therefore normal for them to really ignite at some point. I think a year from now, Ted, you and I will be having a very different conversation.
I certainly believe so too. Now, one of the questions I wanted to ask, we talk a lot about gold, but I do think it's important to remember silver, and it has this tendency to lag gold anyway before outperforming in this explosive fashion. One of the explanations for why silver hasn't gone on to outperform gold yet, at least in my view, is that the silver price is waiting for this confirmation of how severe a recession would be and how much that would affect its industrial component. So I think in your book, you provide some really good figures that help quantify the scale of this industrial demand for silver. One of which you say roughly 20 grams or about 0.643 ounces of silver are used per solar panel. And I know you put a certain number of those on your house, yours and your wife's house, really putting your money where your mouth is. But really what I wanted to get to the bottom of was, a lot of investors are concerned that silver's industrial demand could be somehow hampered by the slowing economic growth in China, who are muddling through. And now in the US, we're seeing more jobs data that's not very impressive as far as economic growth is concerned. So could you just give the investors who are concerned about this some more reasons to be optimistic about silver, and based on what we know about his historical performance relative to gold?
Yes, so it is true that silver is becoming more of an industrial metal, even though production is greater over the past 30, 40 years. A larger and larger percentage of that is going to industrial use. And that's a good thing because it helps society, whether it's EVs or solar panels. And we have, you're right, my money's where my roof is and my money's where my car is, because we have an EV vehicle which uses a battery that has silver in it, and we have solar panels on our roof. So it is true that that's happening. It's also true that silver does not do well in recessions. The only metal that does is gold. Gold usually rises in a recession. Silver, unfortunately, usually falls. So if you fear a recession is here or it's going to be very bad, then silver may not be your prime investment, or we may have to wait until that's over. But I'm not going to invest that way. Because we don't know what's going to happen. And I remember people being very insistent 3 years ago, and I was among that crowd, that the yield curve had inverted in the last 6 recessions. were predicted by the yield curve inverting. And that obviously hasn't happened. Now it still may happen, but you've been waiting for 3 years. And, if silver was at 19 and now it's at 20, what is it, 28 or something? 20. You've kind of missed out by not buying then. So I did buy when silver sold off in the COVID crash in March of 2020. The sell-off was incredible. To me, it was ridiculous because the gold-silver ratio, many people remember, went to over 120. And it had never been that high in all of history, in all of recorded history. The gold-silver ratio had never been that high. I was very public about it. I said, this is ridiculous. I'm jumping in. And I bought silver at $13.05, I think it was. So, you could say I love big dips and I cannot lie, but but I really did want to capitalize on that because the oversold nature of that was incredible. Now, if you look at what happened there, this is a good example of what I think you can expect from silver going forward. I've documented all of its spikes since the 1970s. There's been more than a dozen of them. The average of those spikes is basically a double. If you include the 1970s, it's 154%, all in a relatively short period of time, 12 months or less. The average length of a spike is 7 months. But if you go back to the COVID spike, what happened there, we had the crash. And if you remember, gold and silver really bounced out of that, and so did mining stocks. So I bought silver twice that month toward the end of March, and I just really loaded up on mining stocks, which is another story. But when I bought silver, it was 13 something, and silver rose from that point. Its low within 5 months had risen 140%. 140% in 5 months on that bounce.
Yeah.
Rose 40%. So silver was, what is that? Triple almost what gold did during that time frame, during that run. It also tells you, remember, we were in a recession then, and gold and silver bounced, silver more than gold. So I don't always count that, a recession is a period to avoid silver. I think gold and silver will run in any type of fear, uncertainty, crisis, whatever it is, especially a monetary crisis. If we get something really nasty with the debt or our currency or whatever, and remember, all currencies right now are fiat, every single one. None are backed by any commodity, including gold, for the first time in recorded history. So if we get some kind of, nasty thing with that, you better expect that gold and silver are going to run, and silver will outperform gold. I think most of the audience knows that. Silver historically has outperformed gold. It may not at first, and that's exactly what we're seeing right now, right? But by the end of it, by the end of the bull market, whatever that is, however long it is, silver has historically outperformed gold, and there's no reason to expect that won't happen again, and I'm investing accordingly.
Yes, I would absolutely agree. And 6 out of the 7 last bull markets of gold, silver has outperformed. Is the research that I did for the In Gold We Trust report. Is absolutely the probability is higher, and the margin of safety as well. I think Mike Maloney, one of your colleagues, pointed out that silver is the only metal to have not surpassed its 1980 highs. In a group that includes most of the industrial metals. So I checked that back when I was working with him, and it was an incredible table. We looked at every commodity, and silver was the only one that hadn't surpassed its 1980 high. And then if you inflation adjust it, it's even worse. So I know.
It's really kind of ridiculous. So, but it cannot last. It cannot last because the vulnerabilities in our system are too big, and it will overwhelm this tiny little silver market.
Absolutely. And this erosion of secondary supply that our mutual friend Peter Grout talks about, that can't continue. And ultimately, that brings me to the next part, Jeff, which is how do we get exposure safely to the mining stocks, and how do we avoid the bad ones and identify the good ones? So think you have a really good part about this in chapter 7 of your book, where you lay out your screening process basically for solving this exact problem with this sort of 6 features of this criteria that you look for in a mining company before investing. So they're all beginning with double P's, conveniently. Proven people, participation partners, promising projects, protected politics, potent push, and proper price. Easy for me to say. So in keeping with the theme of all these P's, Jeff, please could you provide a prompt presentation of the points populated by these 6 principles? In other words, talk us through the 6 P's.
Well, it would take a long time to go through all that. That's why I wrote the book. But I did write it, by the way, to answer that very question of how you can invest in this sector and pick more winners than losers. Yeah. But there is no safe way to do it. You asked it how to safely do it, and that there is no safe way. Right. We are speculating. Even if you buy a producer, in my opinion, you're not investing when you buy Apple computer. You're speculating because you believe the price is going to go higher. You used to be able to invest, but now it's more speculating because of how crazy the market's been and how imbalanced, the money being thrown at them, all kinds of things. Anyway, that's another topic. But, I wrote the book to answer that very question. And I think it's, a valid way. I've used it. Let's put it this way. I've used it and been successful with it. I've picked more winners than losers. And, I think someone who doesn't even know a lot about the industry can read that book and walk in and begin to identify who they want to, invest in. So, you can buy GDX or GDXJ, the ETFs. I personally don't do that, but if you don't want to do a little bit of homework and you just want a little exposure, you could do that. I don't do it because you get the bad with the good, right? You get a lot of companies in there. A lot of these, ETFs and funds are based on market cap. They're not based on a screening method to find the best, So that's not really the best way to invest. So I prefer to pick individualized stocks. And I think we're going to have some winners. I do remember a quick story, Ted, back when I was working with Doug Casey's firm. Someone showed me a picture of a new Corvette they bought. And I'm like, wow, that's great. And they said, yeah, I bought it from a mining stock. And I'm like, you bought it from a mining stock? They said, yeah. And this was during a time when mining stocks weren't really doing all that much. Right. But he had a really big winner. And I'll never forget what he told me. He said, you know what, Jeff? It only takes one big winner. Yeah. So if you buy a basket and 9 out of the 10 don't really do anything, but you have one that goes 10x or more, like the other example you shared, that can really change your station in life. Let's put it that way. So that's what I'm after. But the starting point is really the 3 legs of the stool: the people, the property, the politics. If I hear about a drill result and I don't know anything about the company or where it's from or anything, the first thing I'm going to ask is, well, who's behind it and where's it at? Yeah. Because those are starting criteria for me, and if they don't pass those starting criteria, I'm sorry, I'm not going to invest in that stock despite the good drill result. Now, I may miss some, and you can snag some if you really go after that kind of method or something, but I want to reduce my risk. Think about it. We're venture capitalists. One of the last places on earth you can be a venture capitalist by investing in the junior mining sector. And the junior mining sector, as everybody knows, is highly risky. I want to reduce that risk. And so therefore, I'm only investing in pro-mining jurisdictions. You can't pick up your deposit and move it elsewhere. Elon Musk can move his factory to wherever because he doesn't like the politics. We can't move deposits. So you have to invest in countries and jurisdictions that have a strong rule of law, strong protected.
Yeah, Jeff, sorry to interrupt, Jeff. Talk to me about that. It's a really interesting point. Which jurisdictions would you class as the ones that are strong and the ones that are not strong, the ones that you would avoid out of interest?
Well, I do start with, and I say this in the book, the Fraser Mining Institute, the mining survey every year. It's very valuable because the responses are how they do this survey. Uh, the responses are from company executives working in those very countries. So you get really honest opinions about, because it's anonymous, they can reply anonymously. So you get some pretty frank and honest, comments and rankings on countries from them.
And was Canada was number one in I think it might be in the 2022 survey at least anyway.
Yeah, Quebec is always up there. Nevada is always up there. The countries in East Africa are almost always at the bottom. So, but you can use that as a starting point. Once I get outside of there and those areas, BC, I like BC, but you have to have a company and a management team that understands they have to work with First Nations there. It's critical. They won't be permitted if they don't have agreements with First Nations. So if they have that in place, or they have a strong relationship with the First Nation, hey, that they pass that criteria for me. If they don't, then I'm going to be on the sidelines. But once you get beyond those areas, then I'm looking at their rankings, what else is going on in the country, what the history is there, and I also ask other people. Would you invest in a company in country XYZ? And I get feedback that way. So I'm trying to gather as much information as I can. If to invest in Colorado, I'm just picking that out of the sky. But when I get beyond those other areas, that's what I'm going to do. So.
Okay. And in terms of like emerging jurisdictions, like we're seeing a lot of activity pick up in Argentina and Chile and South America. Where would you say is like the next golden triangle, if we were to say, hypothetically?
That's a good question. I think there's still going to be discoveries in the actual Golden Triangle up in BC.
Of course.
There's going to continue to be discoveries in Quebec, believe it or not. You'd think it'd be every inch of it's been walked over by a prospector with a pick, and that's not the case. There are companies there in Quebec I'm pretty excited about. There's still going to be discoveries there. There's still going to be discoveries in Nevada, believe it or not. There's a couple companies in our paid letter that they're right on some trends that have not been explored, at least been underexplored, even if they've had some work done on them. So there's still going to be discoveries there. I do look at Argentina. I do have a company that I own that's in Argentina. Again, it depends on the province. When you get to Argentina, you have to look at the province, Salta probably being the strongest one there. Chile, the same thing. You got to, they're kind of moving more left, less mining friendly. Mining is not going to go away there, but you got to look closely at what's happening and where this company is at. If a company were to make a huge discovery in Chile, I'm not picking on them, but in a country that, isn't maybe top tier in terms of a mining jurisdiction, a pro mining jurisdiction, I'm going to look at, if they make a big discovery, I might look to exit, because the bigger the discovery, the more interested the government's going to be in, increasing tax revenue, royalties, ownership, whatever. And I have no interest going down that path. So I may take the money and run if that happens in what you might call a second tier jurisdiction. So I think it can be very valuable to create your own table of, yes, these are pro mining jurisdictions, and then the other extreme, no, avoid. And then there's going to be a bunch of maybes, right? That's what I did in the book. And the maybes can, that table's going to shift around, but I think if you create that and look at that and keep some notes on why you rated them the way you did, that'll be very helpful. So anyway, that's what I look at political jurisdiction. So I'm looking at the people, where it's at, and then I'll look at the projects. It really is in that order for me. Again, the whole idea being I want to reduce risk. If something bad happens at a project, let's say they have a great drill result, they hit 5 grams over 100 meters or whatever. That's a really good drill hit. But what if the next one is, half a gram over 50 meters? all of a sudden that stock's going to sell off because everybody got excited at that initial drill result. They expected more of that and it didn't happen. What does the management team do to deal with that? How do they handle that? Do they have the, expertise to really evaluate that, reevaluate that, and formulate the next drill plan, or not? Many don't have that ability or at least that experience to handle that. That's why you have to have a strong management team, not just an experienced one, but one that has demonstrated success before in the kind of asset that they're going after now. So that's what I do. And an easy way to do that, by the way, is to look at all the companies that the people that you may be investing in. Look at the CEO and the GO's history. Look at the companies that they ran before, and look at what the stocks did under their tenure of those previous companies. Did they create shareholder value or not? So that's a big factor for me. And even that's not a guarantee of a success, but you're reducing risk. That's the whole idea of this, is to reduce risk so that when your winners come, they're not only big, but you don't have a whole bunch of losers in your portfolio too.
No, that's very interesting. I think as well, whilst we're on the topic of jurisdictions, just briefly you talked before, I've got to ask you about Mexico, and I've got to ask you about, you talk about political risk. How big of a threat really is this new president who's talking the talk when it comes to environmental issues and green? Will she really follow through with this, do you think? And will silver mining in particular be impacted?
I think this is someone who has a PhD in petroleum engineering, oil engineering, I believe. Don't quote me on that. But this is someone who's intimately familiar with, mining and all that in her home country.
Yeah.
She knows what butters the bread for the country. Mining is a big, significant contributor to their GDP. So I don't think she wants to kill the golden goose. And I think she knows that if she tries to nationalize things, she will see a mass exodus from investors out of the country, me included, if she were to do that.
Yeah.
I don't think she'll do that. It's still a hot potato. We don't know exactly how this is going to land, how it's going to end. So one thing, obviously, I think the audience knows is that, that they may try to ban open pit mining.
Yeah.
That's what they don't like. Underground mines are a different story. Now, that's not been passed. There's actually no mining regulation that is on the table to do that. There's a lot of rhetoric and a lot of talk right now.
Yeah.
That's what we don't really know the answer to it. So how I'm handling it is this. First of all, I'm not exiting at least my Mexico mining plays because they're all underground, first of all. Secondly, they're permitted. They're already permitted.
Yeah.
So that gives you a strong base to start from. So I'm not exiting them. I'm probably not going to invest in any open pit things right now, make new investments. But unfortunately, we have to wait and see what law they actually pass and what it means and what it does to mining in the country. We may end up being forced to exit. I certainly hope not. That's not what I think is going to happen. My hope is that, calmer voices rise to the surface here, and we end up being okay. So, unfortunately, it's still a hot potato. We'll see, but that's how I'm handling it for now, anyway.
Yeah, and she would be very counterintuitive to strangle the mining industry like that, like you say. Okay, coming back to the sort of how of mining stocks, just to finish. You talk about in the book about when to sell mining stocks. You talk about the 5 commandments for a mining stock investor. Now, I know we don't have time to do all 5, but there was one that really stuck out to me, which is number 3, which was no chasing. And as part of this, you talked about how you were bitten by the FOMO bug in 2006 when you chased this uranium stock and soon found out that you'd bought in at closer to the top than the bottom. So I think this is such an important trend, especially in an age characterized by traders who chase momentum and growth stocks as opposed to value-focused contrarian plays. So perhaps you could expand on the lessons you learned from that no chasing rule and any other lessons you learned from your investing career as well?
The no chasing rule is actually easy to follow right now because not a lot of things are moving, right?
Yeah.
But you will see stocks that or companies that report good news and the stock will jump 20%. It's on days like that where you don't want to chase because there's always pullbacks, especially with huge gains in one day, right? So it's easier to follow now. What I think is going to happen at some point, though, we're going to get into a bull market, and then it'll be a raging bull market, and then the possibility is high, in my opinion, that we go into a mania, and that's when people will chase. We'll see a lot of new people coming in, and you just gotta. At that point, you don't want to chase, but you want to hold on for your life, and then we'll be exiting at some point. In the middle of that mania, hopefully.
Yeah.
But it's easy to follow right now. And I do use stink bids. I really encourage people to use stink bids to, if you're looking to buy a stock, just bid slightly under the market. Don't buy at the ask, especially for a junior, because there may be a 20% spread there, and you do not want to do that.
Yeah.
And in the current market, even though volatility is low and volume is low, although volume is picking up, that's another clue that we might be getting started here. But generally speaking, volumes historically are still low right now. So you can use a stink bid and, you're not going to get something 50% under market unless there's company bad news, then you don't want it. But you might bid like 5% under market, something like that, and just get someone who's, ready to sell. And we're in September already. The year's going fast, but we're going to get to a point where we have some tax loss selling too, and there will be tax loss selling this year. So I would target, have your watch list, but target the companies that you might have your eye on if you don't expect big news, by the end of the year that you might want to pick up on a tax loss selling event.
I see. Yeah, that's good advice.
How I would view all this, Ted, is, gold is like your grandpa. Steady, strong, friendly, always going to be there for you. That's true. That's what gold is.
Yeah.
Gold stocks are very different. They're like your cousin or whatever, they're going to be volatile. But they can
can be your friend at times as well, like Peter says about silver. Volatility.
Right. Absolutely. It can be your friend. I have a whole article on that's another topic, but use volatility to your advantage. Absolutely. So yeah, that's kind of how I view the sector. Gold and gold stocks are very different. So just keep that in mind. If you don't have a material amount of gold, I would buy on dips. And by material, I mean you have to own more than 5% of your portfolio in gold. I personally have roughly 20%, and that's based on research from history. If you own less than 5%, it's really not going to make a material difference if things go wonky. So I would encourage people to invest more in their grandpa if they haven't already.
Which is hilarious at a time when I think around 1% of family offices have a commodities allocation in general. I think it's starting to rise slightly, but it's still crazy when you think about the scale of the opportunity. And I did want to ask you that, kind of like a quick fire round in terms of commodities outside of gold and silver. We mentioned uranium earlier. I know you liked uranium, and I know you've got a few investments. What's your take on where the spot price is headed? I think it was around $79 last time I checked. And how bullish are you on uranium miners going into 2025?
Yeah, I think the uranium spot price is going to go higher over time. Who knows how high and how long it takes and all that. But I'm invested pretty heavily in uranium stocks because of the supply-demand crunch. We're just, especially in North America, U.S. and Canada just aren't going to have enough uranium when they cut off Russia completely. So there's that. It's also green because it doesn't emit greenhouse gases. So politicians and environmentalists, many of them like it. And then you have a bull market that's, this market's been dead for a long time. The bull has woken up, had a little correction here. That's a good time to pick up things, but I'm very bullish on uranium.
Nice, nice. Me too. And copper, I like copper right now in terms of a play to load up on now in case we do go into a recession. It's not that maybe if we get a hard landing, for example, it may not outperform for 2 or 3 years, but I just think the scale of AI demand is going to be so huge. And even if we get some kind of headwinds from the EV revolution, then it's going to be huge. Would you agree with that? Are you bullish on copper?
Yeah, I'm very bullish on copper. It's got a lot of the same things going on as uranium supply demand issue. People, politicians, environmentalists behind it. It's AI, but it's everything. It's all electrification. If you want to electrify and go green, you're going to need more copper. So I'm very bullish for that reason. The copper price has never risen in a recession, ever.
Yeah.
Since going back to the 1970s, but we're not investing in copper. I don't buy copper futures. I'm investing in copper mining stocks that can make a discovery, make a material difference to their portfolio and rise despite what may be going on in the background or in the economy or whatever.
Yeah, it's absolutely true. You get that leverage. Last one is platinum and platinum group metals. I think Rick Rule always says, he likes when an investment is unloved. I'm probably the same in that sense. The platinum is being disregarded, and it's causing me to sort of think, why is there an opportunity there as a contrarian play? A lot of it's South African and Russian based, the supply, so that comes with jurisdictional risk, which we talked about earlier. But there are still supply deficits being reported by the World Platinum Investment Council. So where do you stand on PGMs at this moment in time?
I'm not invested in them. I might look at a PGM mining stock if it was extremely compelling. But PGMs also have not risen in a recession. So I'm a little hesitant with them, mainly because 90%, 95%, depending on who you listen to, of their use is industrial. And so it's heavily dependent on economic health. I think that'll come around, but I'm currently not invested in them or any PGM stocks.
Okay. I think there could be a case where if certain conditions are filled, like the green energy transition falls flat on its face, and we do have a soft landing, that could be the perfect marriage, and it may be worth exposure for those reasons. But yeah, it's certainly not the top of our list at the moment. Okay, Jeff, I think that's a good note to end on. I know you've got to go, so please let our viewers know where they can find you. And I know you just started working with Peter Krauth a few months ago, so let them know. Yeah,
so everything's at thegoldadvisor.com. And, we always talk about M&A in the junior sector. Well, we've had some M&A in the newsletter industry, too, because I did buy Gwen Preston's Resource Maven list. She went off to do some other things, but Peter Krauth came over as well. So he's with us. So we've got a brand new website, and we're pumping out a lot of information every day, both free and paid, for investors. And you know what? It's an over-the-shoulder thing. It's what Peter and I are personally doing, and I have another part-time analyst as well. It's what we're personally doing. And you can look at our portfolios and decide for yourself if these are stocks that you want to own as well. So we're sharing that with people. The idea that I do want to help, I do want to help, even though I'm charging for a paid newsletter. It's not expensive though. I do think I'm going to make a lot more money on my stocks than on, the goldadvisor.com. And that'll be fine with me. Having a few 10 baggers would be awfully nice. So we hope people will come and check it out. A lot of resources there.
Certainly. Okay, Jeff, thank you for coming on, and thank you for listening. This has been VRIC Media.